Well, let's turn now to the advisory with Justine Marquet from Allianz Retire. Justine, you've just returned from a national roadshow. What was the main takeaway?
Well, there's definitely some consistencies in views between the analysts that are speaking around the country and the advisors, and that is that there's increasing volatility and concentration in the markets, and it's increasingly difficult to find quality non-correlated assets in portfolios. And that in turn brings about this really serious prospect of sequencing risk for their retiree clients. And at the same time, we're seeing this ongoing cost of living pressure, which does affect people who aren't working, i.e. retirees, disproportionately because of their basket of goods. So advisors are looking to find different ways to solve for these problems. It was interesting to me just to see how they're utilising longevity products differently than the standard use case.
And what would be some of those sort of different approaches that you saw?
All right, so certainly combating the volatility in markets and the sequencing risk that retirees face into, I think, is a big one. And what we know is that during that retirement risk zone, which is kind of the 5 years before and 5 years after retirement, sometimes the 10 years into retirement, if we see real volatility in the order of returns, that can have a major impact on the value of the portfolio over the longer term. So advisors are looking to get some downside protection into the portfolio during that risky period. So they're utilising products that incorporate that, a bit of a safety net underneath those assets, particularly assets they've put aside to fund essential income during retirement.
And a lot of portfolios are heavily weighted towards global and US growth assets. Are there issues with that when actually living off it for retirement?
Yeah, there are. So some advisors are still very much invested in those markets. They've been performing super well, of course. That concentration has a lot to do with it. But finding income from those assets is a little more difficult. So they're looking to annuity style products to put into the portfolio just to punch that regular income into clients' cash accounts every month so that they can stay invested in these global assets that have so much growth trajectory. They need income, and Australian assets classically provide income, Australian equity assets, but it's the global assets that are showing all the performance at the moment.
And you mentioned annuities there. What are lifetime annuities offering SMSF trustees now that maybe wasn't available, say, a decade ago?
That's another really interesting strategy. So it also speaks to the need for cash and having that regular cash injection in a fund. And SMSFs, like all superannuation funds, need to meet minimum pension requirements in Australia. So there's minimum pension payments that need to be made from account-based pensions. And so by having an annuity in the fund itself, owned by the trustees, they can ensure that there's always a cash injection and they can meet their minimum pension requirements, even if some of their other assets aren't paying income for the moment, or they've got lumpy assets like commercial property, and there's between leases or whatever the case may be. So it's helped propping up that cash need to meet pension requirements.
And who should be thinking about the strategy, and when should they start in that sense?
Well, there's a real opportunity to start earlier. So these days you can access sort of the relatively high part of the yield curve that we're in and secure a future income rate now without having to take the income. So people can invest now, keep growing their asset, their annuity, and then turn on the income later and realise the benefit of that growth in the underlying investment, but also the growth in the income. So they get a much higher income rate if they turn it on later. And this could be useful even to fund aged care, for example. So we know that aged care costs are increasing. And in today's dollars, you know, people going into aged care can expect to fund anywhere between $30,000 to $1,000 a year to pay for that care. Particularly if they're self-funded, they'll be at the higher end of that spectrum. So for a relatively efficient use of capital, a relatively smaller amount that you can put aside now, if you do that earlier and allow time for it to grow and the income rate to grow, when you turn it on, it will be paying a significant amount of income on the balance right when you need it, which is later. Like, we often think about spending needs decreasing over time in retirement, but then when you need aged care, that money's got to come from somewhere. And if there's someone still in the house and it can't be sold, do they look to the children? How are we funding that requirement to pay those costs?
I think you've referred to aged care as a bit of a sleeper issue in retirement planning. Why do you think it is still flying under the radar? Is it just that people don't want to sort of necessarily think about it, or?
I think that's the case. Yeah, I think there's this sort of view. It's funny, our population is ageing, but this vast majority of people coming through haven't quite got there yet. There's still a lot of retirees, but there will be this big movement into aged care, and there'll be more demand for limited services, so costs will increase, and the government can't continue to fund lots of public spaces. Self-funded retirees will have to come up with the cash, and I think we're moving more to daily fees rather than sort of the ability to pay a lump sum up front and hope that takes care of it.
So if someone's at home listening today and they're approaching retirement, what would be one thing that you would want them to go and check straight away?
I would get them to talk to their advisor, to their financial advisor, about the types of longevity income streams and guaranteed lifetime income streams that are in market now, because they're really efficient way to get non-correlated guaranteed income into their portfolio and right now, with all the volatility and everything going on, if they want to remove some of that risk around the risk zone, if they're coming up to retirement, they can get some downside protection built in, and I think that's really valuable.